Good day, distinguished clients, ladies and gentlemen. It's my pleasure to welcome you all to Stanbic IBTC Nigeria's webinar series. My name is Muyiwa Oni. I am the Regional Head of Equity Research for Standard Bank for West Africa, and I will be one of the moderators for the macro session. I also have my colleague, Blessing Oladipo, who is our Nigeria economist, and she will moderate the session with me. I will now call on Demola Shogunle, the CEO of Stanbic IBTC Holdings, to give the opening remarks.
Yes, thank you, Muyiwa. Good day to all our distinguished, customers, clients, invited guests. I'm saying good day deliberately because, under the virtual environment, as we speak now is about 1:30 or 1:36 in Lagos. It should be around 2:36, p.m. in Joburg. It should be 3:36 p.m. in Nairobi. It should be 4:36 or so in Dubai. And in New York, we should be talking about 8:36 in the morning. So wherever your coordinates are, good day to you. And the important thing is to thank you and to appreciate you for joining us today. We are very grateful for all the tremendous support that you're giving Stanbic IBTC and Standard Bank. And we are pleased to be able, post-COVID, to be able to connect, with you at this point in time to discuss real topical issues, topical developments, in the economy, of Nigeria. We would like to thank, all our speakers. We would like to thank Ari, and all the business leaders who are taking time out, to join us today on this platform. Please, all the speakers are uniquely, placed, and intentionally, chosen, to be able to highlight key insights that will be of tremendous benefit to all of us, in terms of how we plan the year, being a pre-general election year for Nigeria. Don't forget that the general elections will take place next year, 2023. So this engagement, this platform promises to be very, very enlightening, and I would like to thank you once again. Have a good day. Thank you. Muyiwa, back to you.
Thank you very much, Demola. So before I call on Mr. Ari Eisen, the International Monetary Fund Nigeria resident representative, to give a presentation, presenting his views on the Nigerian economy, I will like to highlight some housekeeping rules for our Q&A session. So all participants will be muted. So please type in your questions or comments in the Q&A tab. And we also plan to send the presentation that Mr. Eisen would make to clients and participants at the end of the session. So look out for that in your email boxes. Once again, it's my pleasure to welcome you all. And before I call on Ari, I will give a short profile for Mr. Ari before he gives his presentation. Mr. Eisen is a national of Brazil. He joined the IMF in 2003 and has gained extensive experience as a macroeconomist during his career. He has worked in the Western Hemisphere, Asia Pacific, Middle East and Central Asia, Africa, and Monetary and Central Markets Department, covering a wide range of countries, including Bolivia, Dominican Republic, Mozambique, Nepal, Tajikistan, Uganda, and Uruguay. Mr. Eisen spent several years at the Central Bank of Chile, where he accumulated experience on monetary policy under inflation targeting and was able to significantly contribute to the development of inflation targeting in Uganda. Throughout his career at the IMF, Mr. Eisen was resident representative twice, in Tajikistan from 2010 to 2013, and in Mozambique from 2016 to 2020. He is currently the resident representative of the IMF office in Nigeria, and he started that in October 2020. Before joining the IMF, Mr. Eisen was a student at the University of California in Los Angeles, where he concluded his PhD in 2003. He taught macroeconomics, monetary economics and international finance and trade in various universities in Brazil, Chile, Israel, and the United States, and has published several academic articles in internationally renowned journals in fields of international finance, macroeconomics, and political economy. It's my pleasure to welcome Mr. Eisen to make his presentation.
Thank you very much, Muiwa, and colleagues from Stanbic. It's a great honor to be here with you, with your investors, and share some views of the IMF, of the Nigerian economy, developments, outlook, and certainly after the presentation, I'll be very interested in discussions and questions that you may have. Thank you also for this kind introduction. So without delay, let me just share the presentation and we can then start. And thank you also to my colleague Shegonle for this wonderful introduction. Let me see. Can you see the presentation?
Yes, we can.
Very good. So as I said, we are going to cover the recent developments, outlook, and some challenges that we see for the Nigerian economy. I'm now in Washington because we are still within the spring meetings here in Washington, D.C., IMF and World Bank spring meetings. And we had a delegation of Nigeria also attending the spring meetings. And so these economic views were also discussed with our counterparts in government during the discussions, and also with other investors that we usually reach out during this time. We have published our forecasts on Nigeria in the World Economic Outlook that was just published last week. We are also going to provide more details on Nigeria and other sub-Saharan African countries in the upcoming publication of the Regional Economic Outlook for Sub-Saharan Africa. And we will also make a presentation later in Abuja and maybe Lagos on this Regional Economic Outlook, probably sometime next month. But with that, let me just start with this presentation. Okay, so the first thing to note is that the economy in 2021 rebounded, and rebounded quite strongly compared to what we were projecting earlier. And you know, this rebound, the economy grew last year at 3.4% in 2021, rebounding from a negative growth, from a contraction in 2020. This was broad-based. Certainly the service sector was the main contributor to this positive performance. The oil sector has not contributed much, and in fact, its share in GDP declined to about less than 7.5% of total GDP at this point. Agriculture performed reasonably well, as it has always been performing, but in the fourth quarter, it did even a little more in terms of contribution to growth and its participation of about 25% of total GDP. But the service sector is the big story here, really, for real GDP growth. And when you go into the growth in the service sector, what you see is that it's quite broad-based, and particularly wholesale and retail trade, real estate, were sectors that performed much better compared to 2020. They grew at very strong rates. Of course, a lot of these are base effects that were not very good in 2021, meaning that there were severe contractions in those sectors in 2020. But having said that, by looking into the broad-based growth performance within service sector and within the economy as a whole, this tells us that there is some positive momentum. And in fact, our projection was about, with the information we had on Q3, was about 3%. And as I said, overall growth was 3.4, so surprised us on the upside. It also surprised most analysts who even had lower growth forecasts than us, and even the central bank, who was not projecting that high growth rate. So this is good news for the Nigerian economy. A lot of this good performance, in our view, was helped by limited COVID cases that allowed resumption of activities after the severe lockdown in the second quarter of 2020. So you here in the left-hand side, you see this chart of the COVID-19 cases. That's a 7-day moving average. And you see that Nigeria, as other countries, had several peaks and of the different waves. Here we see 4 waves. And now it's really a very, very low level of new cases. The waves in Nigeria behave very similarly to the waves in sub-Saharan Africa, so no surprises there. And you know, and all these happened despite the fact that Nigeria has a lower level of full vaccination or even partially vaccinated people. The share is still much lower than the average of sub-Saharan Africa. So part of this is despite low vaccination, but that also carries some risk going forward, simply because we, although that the COVID pandemic has in many ways dissipated, and hopefully it will continue like that, it's not fully defeated. And we have learned that with the variants, there is always a risk that new variants appear and they can be affecting countries in severe ways. And we certainly don't hope that, but it's difficult to tell. And the best protection against new variants these days, that's what the medical science is telling us, is through vaccination. So it's very important that this process continues in Nigeria. We understand that supplies of vaccines have been increasing substantially. So it's a question really of providing those shots to people all over the country at a faster rate, if you wish, and avoiding some of the constraints in delivery, being hesitation from those who need to get the shots, or some logistical constraints that may be around. Also good news on the capital markets. Nigeria had a successful return to the Eurobond in October 2020. It raised $4 billion. In 2022, less than a month ago, it raised another $1.25 billion. It was in fact the second emerging economy raising funds in 2022 after Turkey in the Eurobond markets. And it did that with a reasonable level of spreads. If you go here on the right-hand side, Nigerian spreads have been virtually constant, with a slight inclination since January 2021, meaning that most likely, not different from most of the other countries. I think here, Angola, you see a decline from the beginning of the year, but spreads in terms of levels are still higher or comparable to Nigeria, a little lower now. But you know, in most cases, the increasing spreads are related most likely to geopolitical problems in the case of the Ukraine war, but also tightened monetary policy in the US and in other central banks. We'll comment about those later on. But all in all, a good issuance of Eurobonds that allowed for financing of the deficits, rates commensurate with the ratings in between B-, B, and B+, where Nigeria belongs in that group, together with Turkey, Egypt, Ecuador, Ukraine. So no news there, and in fact, relatively positive news. On the current account, we also see the current account narrowing, still in deficit, but a small deficit as of now in billions of dollars, about, I think here in the chart you can see maybe $2 billion. That is a major improvement compared to 2020. And that improvement comes on the back of an improved trade balance in goods and services, mostly on goods where imports have not increased or have declined by more than the decline in exports. Also, as of late, the oil sector is supporting exports. Of course, petroleum products in Nigeria are imported given the inexistent level of refining capacity at the moment. But overall, Nigeria exports more crude than it imports in refined products. So there is some contribution there also happening in the external accounts. And as a result, we see the current account narrowing. Despite the narrowing of the current account, we see that foreign exchange supply through the various windows have been limited. And that has created some shortage. So whatever from the INE or the NAFEX rate, the window, used to be a very busy, high turnovers of foreign exchange trading there, and that has never returned to pre-pandemic levels. So that shortage in supply, because demand is still out there, has created what we see here in this blue line and the right-hand side, a premium of about 35 to 40% between the parallel market rate and the INE exchange rate. That premium has been maintained at that high level, reflecting that the supply of foreign exchange in those windows is really not enough to compensate for the demand. So that mismatch is therefore creating the premium in the foreign exchange market. What about the war in Ukraine? What do we see? We see clearly higher oil prices, and that is true for Brent, Bonny, and also not only spot prices, but future for March 23, March 24. That is reflecting some sort of supply being tightened in the oil sector. So that is positive news for Nigeria as long as the oil prices per barrel are above $80. That's certainly positive for the Nigerian economy. Having said that, the volumes are below the OPEC quota. OPEC quota resumed its increase after a decline earlier in 2020, and it's now back to pre-pandemic levels in terms of quota, but the volumes declined significantly. And we saw that in terms of the contribution to growth, that the oil sector, real growth of the sector is actually negative. And that reflects exactly this chart, that despite high prices, we don't see an increase in volumes. That has constrained the capacity of the current cycle of positive oil prices to contribute to economic growth even to the balance of payments and to tax revenues in Nigeria. So it's very important that Nigeria is able to increase its production of oil to take advantage of these high oil prices, and that windfall would contribute to all these important indicators, the balance of payments, the tax revenue intake, and also the economy as a whole. Because we see that high oil prices doesn't contribute only to the oil sector growth, but there are spillovers benefiting the economy in various other sectors of the economy. So it's important to tackle, in our view, those constraints that are limiting the increase in oil production, being governance issues, stealth, that is quite a bit of stealing of fuel, and so unless this is resolved or at least reduced, mitigated, those volumes, and also, of course, higher investments that are needed in the sector to boost the capacity. But these investments can only happen with a better environment, more conducive environment for oil investments and production. So these are all part of the same context where a positive terms of trade cannot be taking full advantage in terms of the economy, because the supply cannot respond in terms of higher oil volumes benefiting the economy. And exactly as I said, the fiscal is yet to benefit from these high oil prices. What we see, and this is a long series since January 2010, that whenever oil prices, and here you have the Bonny light, which is relevant for Nigeria, whenever they increase, oil revenues increase as well. And now we are increasing already above 100. There are a slight decline in the last few days, but you see these blue bars on the left-hand side not increasing significantly. So there is space for higher tax revenues. Important, of course, to make sure that oil companies are paying those tax revenues that they should pay, and it's a question of tax administration, but also that volumes increase so you can see those increased tax revenues. Part of the problem of the low tax intake lies with this right-hand side chart here, where you see large PMS petrol subsidies that, of course, with the increase of the refined products, the price of refined products, and while the domestic price has been maintained the same virtually for a long time now, the subsidy, the implicit subsidy, has increased. And this subsidy is deducted from the tax intake directly in the way the Nigerians do their burden sharing of tax revenues. So that has actually constrained the ability of the government to collect more tax revenues. So as we said before, it would be important to remove those few subsidies. There was a decision by the government to postpone this removal by 18 months back in February this year. So this is only going to happen in 2023. Having said that, and also, as you may know, the government is looking for additional resources in the budget, and is going probably for a budget amendment to get additional funding and financing to provide for this subsidy in oil revenues. Other effects of the war in Ukraine are higher food prices. So you can see here in that fertilizers are increasing substantially in terms of prices. Price of grains are increasing, and food in general, and even metals and minerals. So quite a bit of a broad increase in prices of commodities. The biggest concern there, particularly with fertilizers and grains, is with the food inflation. As you can see here, imported food has been increasing, and food prices, also the prices of those goods that are produced domestically, they have been increasing by more than the core inflation, which has also been increasing, reflecting some dissemination of price increases within the basket. But the basket is highly influenced by food in Nigeria as a developing economy. So it's very hard not to get the dissemination of prices within the basket when you have a sustained and systemic increase in food prices, as we've been having over the several months, with peak in middle of 2021. Now in 2022, because of the war in Ukraine, we are seeing last month, inflation was a little higher, 15.92%, helped or supported by higher food prices, more than the core. And food is running above 17% as of last month. We don't have here all these in this chart, but all in all, food prices have remained a pressure point for inflation in Nigeria, and it's something that it's likely to continue and may require some reaction from the policy side on monetary and fiscal policies. On the basis of what we have observed so far, we have revised not only Nigeria, but globally. As I said, the IMF published the World Economic Outlook last week. And in that revision, compared to the January forecasts, our forecast point to lower near-term growth for the world and higher inflation for the world. So, for example, in 2022, we reduced growth, global growth, from 4.4 to 3.6%. That is being carried also for 2023, from 3.8 to 3.6. That is a strong decline in the advanced economies and emerging developing economies, as you can see from the left-hand side table. The exception actually is Sub-Saharan Africa, and because of Nigeria, as we'll see in a second, more than anyone, as the biggest giant of Africa. Sub-Saharan Africa growth was revised upwards in 2022 from 3.7 to 3.8, virtually constant, and Nigeria contributed to that revision upwards. And that the forecast was left at 4% for 2023. But as I said, in general, emerging market, developing economies, especially China, advanced economies, particularly Europe, but also a little in the US, they were all revised downwards in terms of growth. On the right-hand side, you see inflation forecasts all over the world were revised upwards from 3.9 to 5.7% in advanced economies in 2022, 5.9 to 8.7 for emerging economies, and even in Sub-Saharan Africa from 9.6 to 12.2. As our managing director has been saying, the war in Ukraine is hunger and inflation in Africa. So food issues are central to our economies in Sub-Saharan Africa. And we will talk a little bit more about that as well as we move. So in Nigeria, as we have been saying, hopefully that is a message that you can get from this presentation. The impact of the war in our forecasts reflect that. It's mixed. So as we said, real GDP, we have revised upwards from 2.7 to 3.4% this year, in light of the strong momentum that we observed in Q4, beyond the base effects that contribute to the good performance in 2021, which led to 3.6%. We now have 3.4% in 2022. That carries to 3.1% in 2023. Inflation is also higher, particularly because of food. 16.1% in 2022 is our new forecast compared to January. The overall fiscal balance reflects slightly higher this year, and then a little higher even further in 2023, 5.9%. This is reflecting the subsidies among other issues on the fiscal side. Public debt is now forecast to increase to 37.4, 38.8 in 2023. That's still a moderate level, but much higher than what we used to have back before the pandemic, where it was little under 30%. But still 38.8 in 2023, it's moderate. But of course, something needs to be done for public debt not to continue this high increase going forward. The balance of payments, the current account, as we said, has narrowed this year in 2021. Projection is also that it's going to continue at similar rates, 1% of GDP, but lower, much narrower than we were projecting before. Reserves are going to be sustained at above 40 billion, contributing with the high oil prices environment that we see. There will be possible, in our view, to accumulate an additional level of international reserves. External debt, more or less without much changes, and this is reflecting a high sustained level of bonylite prices that are being forecast for 2022 and 2023 above 100. Of course, several of these forecasts will change if the price of oil would suddenly decline. But as we said, there are indications that there is tightness in the supply of oil in the next years, which may contribute, if the global economy is going to recover, is going probably to contribute to prices being elevated and benefiting the Nigerian economy. What are some of the downside risks that we see? Rising borrowing costs. Simply, we see here in the left-hand side, monetary policy has been tightened in several countries. Here we put some examples. Maybe the only exception there is China, but there are forecasts for tightening in the US. The first quarter of 23, market is already expecting 3% federal funds rate. The 10-year Treasury bond is already hovering around 3%. It declined in the last few days because of some protection. Investors, because of some risks in China and other places, have decided to buy Treasury bonds. But overall, yields are much higher than they used to be, and in between 2.8 to 3% they may reach the Treasury year, 10-year Treasury bond. Eurozone, there is some slower, but also tightening. And you know, in some countries, Brazil is not here, my own country, very high rates by the central bank. Chile also increased in Latin America. Turkey, you see here, 14%. Of course, inflation is high also in some of these countries, and a tightened monetary policy is trying to reduce some of these inflationary policies, inflationary pressures that we see. So one risk for Nigeria is that there might be a need for tighter liquidity within Nigeria, but certainly the global liquidity environment that was ample liquidity is not going to be there any longer, and it's going to affect capital flows to Nigeria and from Nigeria outflows, and that that of course they will be affected. Of course, in terms of portfolio flows, you do not have at the current stage much going to Nigeria as you used to have prior to pandemic. So outflows on that particular line in the balance of payments will be limited. But of course, there are other flows that are important. The Eurobond issuances, borrowing, FDI also may have actually be affected by global liquidity. So you should not discount that effect, which comes from the push side the balance of payments from international liquidity to emerging economies. And that is the environment we will be living. And that is a risk to Nigeria, as it is for any emerging economy and frontier economy. Another risk, as I highlighted already, is food, the food insecurity. And you have pockets of food insecurity in Nigeria. They may come to emergency levels in parts of the Borno state in the northeast. You also have crisis. This is the orange section there. And certainly the war in Ukraine doesn't contribute much to that. It's important that assistance continues for those pockets of food insecurity to Nigeria. I'm referring to international assistance, as it's typical in this season, this part of the year, that there are always difficulties. Our colleagues from FAO and WFP are very active in that part of the country, particularly providing humanitarian assistance. Of course, the war in Ukraine creates problems in other parts of the world, particularly in surrounding countries to the Ukraine, lots of refugees. Humanitarian assistance is important there. So in between the limited supply of financing and higher food prices, we hope that the issue of food insecurity in Nigeria doesn't take a toll from those developments, and they can be addressed properly as they have been tried to address, particularly in the Northeast and the Northwest, as you see here, in some states where food security also has been affected, also in some cases by insecurity in general that is pervasive in some areas of the country. So hopefully this can be mitigated, and that risk doesn't present itself in a more pronounced way. I will stop here, and we'll be happy to entertain questions and observations and learn from all of you during this Q&A session. Thank you very much.
Thank you very much, Ari, for the excellent presentation. I suppose before I hand over to Blessing to moderate the Q&A session, just wanted to do a very short recap of your presentation, if you don't mind. I guess if I start with the positives, the oil price environment seemed to support a more positive outlook for Nigeria. I guess there's also the view of a better than expected rebound in the economy. So given how COVID had limited impact on the economy, there was a stronger recovery from that aspect, which was surprising to the analyst community, to the central bank as well. And suppose if one looks at the risks, particularly if we start from the war in Ukraine, a key challenge would be inflation in general. So impact on food prices, impact from particularly if we think about the subsidy, how that has a negative impact on the fiscal as well, and on tax revenues for government. That's clearly an area that needs to be resolved. And then suppose from a food insecurity point of view, there is the security challenges that is contributing to that. That's the internal security challenges. The war in Ukraine also having a negative impact on grain prices, which is negative for parts of the country that already have this food insecurity. Thank you very much for the presentation. I'll now call on Blessing to moderate the Q&A session.
Thank you, Muiwa, and thank you, Mr. Eisen, for the insightful presentation. Good day, ladies and gentlemen. Trust this session has been insightful so far. We'll be taking questions now. If you have questions, kindly drop them in the Q&A tab, and we'll be glad to take those questions within the allotted timeline. While we await questions, we'd love to start with some from our side. Talking about the IMF World Bank spring meetings currently ongoing, we'd love to know what investors, the views investors have about the country from the interactions you have had so far.
Thank you, Blessing. And let me say that again, I'm a big fan of your name, Blessing, and I hope that you blessed us all, and especially Nigeria. The IMF World Bank spring meetings have been actually very active. We are still doing this in an hybrid format as we are leaving the pandemic. But we did have an opportunity to meet presentially with investors from all over the world who joined in Washington this year. And we, you know, from the discussions that we held with investors here in the US, by the way, where I'm speaking from at the moment, some of the concerns they raised are actually reflected in the presentation we made. No? So part of the questions they have was regarding the oil prices. There is an expectation that when oil prices are strong, that the indicators in Nigeria substantially improve. This is, to some extent, is happening, but perhaps not to the extent that most would expect. So that has been an area, and our discussion during the presentation on oil production and the volumes is probably part of that issue, and it's something that was of interest to investors. And how could Nigeria maximize, in fact, the benefits of the current favorable context, at least from the side of oil. Some concerns, some issues regarding inflation and what policies, particularly monetary policy, has been doing and what it can do to mitigate, reduce, fight inflation. Particularly at a time that the rates, and not only the central bank rate, the rates in the market, they are negative real rates. They are much lower than the inflation rates by a substantial amount. So how can you try to fight inflation? That is what they ask. If real rates are going to be very low, and what would it take for rates, market rates, to go up to more meaningful levels? And that was one question. And what is the consequence for the economy if real rates remain at negative territory for a long time? That was one question that some investors also were asking. Questions about food insecurity, food prices, the impact on the poor was of actually quite interest to many investors, especially those who are very interested in environment, governance, and sustainability issues. The issue of the ESG that we hear more and more often in capital markets are important to investors. So if traditionally those issues were not part of discussions, now they become more and more prevalent in discussions with investors. No? Finally, some interest on the Eurobond issuance, perhaps a new issuance coming, as highlighted by the DMO, the Debt Management Office. What does it mean, the previous issuances? Some discussion, was it good? Is it going to continue to be good given the international conditions that might change? Is it appropriate? What is it financing? And, you know, things of questions of this sort. And some actually were asking regarding the sustainability of and breaking points of how much can Nigeria continue to rely on financing of large fiscal deficits. So this is more or less in a nutshell some of the issues that we try even in the presentation to highlight. some of the challenges, but also some of the positives that they also recognize, particularly coming from the oil prices, but expecting that that could be even more positive than what we are currently seeing.
Thank you very much for that. And another one would be on the recently revised Nigeria's growth forecast. So one of the reasons we saw from the report is the increased oil price environment. So we would love to know if the IMF has also incorporated the impact of the declining oil production levels and also the increased cost for subsidy given the higher oil prices.
Yeah, we on the growth, yes, we definitely we were surprised negatively in 2021 by the low levels of production. So by now we are not building in a strong rebound in oil volumes. There is hope that they will rebound significantly. In fact, I think the latest information we got points to some recovery in oil production in the last month. So we have to wait and see for that. But let me tell you that as a share of GDP, oil is 7.5%, even a little less than that. So even if the oil volumes don't increase that much, the incidence, on overall growth is not huge, directly at least in terms of the volume of production. Of course, because the income that it brings and the income for the economy is spread all over several sectors, there are indirect positive effects from that terms of trade shock that positively may affect growth. So we are taking that into account in our growth projections. So of course, we have raised our growth projection, but we have not raised by that much. If you just take the 0.7 percentage point, they mimic the 0.6% surprise that we had vis-a-vis our last forecast. So a lot of this is just carryover of positive momentum. So we are not expecting quite, if you tell me that volume of production of oil will increase, that forecast probably would have an upside to it. We can grow at higher rates. That has a conservative forecast for oil production built in. Sorry, you had asked a second question regarding this. I missed.
Yes, that's the impact of subsidy on the goods, the forecast.
Yeah, the subsidy is more of a consequence than, of course, to growth, it doesn't make much change. In fact, one would say that, yeah, it's positive for growth because the consumption is higher of fuel than it would be if prices would increase. But it's hard to measure the direct impact on growth from the fuel subsidy. Certainly, it has a benefit on inflation that keeps subsidy price, fuel prices constant. But I think that there is a negative impact for the fiscal accounts and overall the financing picture that might require even eventually central bank financing of the deficit, which is not good for inflation, at least not in the medium to long term. So I think the issue of the fuel subsidies is built into our fiscal deficit projections, and overall it has a mixed impact. In the short term, may have even some small benefits, but in the medium to long term, from a macro stability and fiscal sustainability point of view, we strongly argue for the removal of the fuel subsidies, as we have been doing for quite some time.
Okay, Mr. Isen. So we'll start taking questions from the chat room. Ladies and gentlemen, please be reminded you can put your questions in the Q&A tab, and we'd love to take them within the allotted timeline. So the first word we have here is at what level do you believe that the oil price, rising oil prices, will be harmful for global demand and growth?
A very good question. There is some discussion that at the current prices, there will be some destruction of demand because oil prices have been very high. And at these levels, of course, consumers will try to find alternatives to oil. And some of the demand, given the growth recovery that is ongoing, there is also discussion how sustainable that growth recovery will be. Some discussions of eventual recession in the US. It's a little bit too early to predict that, but some in the markets are already predicting that, given the high level of inflation in the United States. But overall, if prices remain very, very high, there will be some demand destruction, oil demand destruction. And, you know, eventually people will look for other alternatives to oil consumption. We need to see what the impact of that will be over time on prices, which we know it may exist, and the OPEC, in fact, may react to that as well. Having said that, there are clear supply constraints after years of low investment in the sector. So the medium to long term, some of this destruction in demand was already happening because of the green economy that many were forecasting. But in the short term, you cannot get to the green economy right away. So in between this short, medium, long term and mismatches between supply and demand, it's not very easy to predict and project what oil prices will be. But certainly, it's a very good point to raise that at these price levels, over time, you may see some demand destruction. But clearly, the alternatives are not fully there yet to compensate for lower demand of oil because of these high prices. So we'll have to monitor the sector very closely going forward. And if you are Nigerian, you have a special interest to monitor these developments because they are important for the economy, of course.
Thank you, Mr. Isen. The next one is on inflation. The question is, what tools are available to policymakers to tackle inflation, particularly food inflation that you emphasized in your presentation?
There's another excellent question. You know, traditionally, and I speak as a previous central banker, traditionally, when one sees high inflation, one has the tendency to suggest that interest rates need to be much higher as a policy tool, and that can constrain demand. And by constraining demand for a given supply of goods in the economy, you may see prices decelerating. That is, of course, not true all the time, and also it's important to recognize the transmission mechanism of monetary policy. How fast and how strong this transmission is for each country, because that will give us a hint of how much rates would have to be tightened so that with the transmission that is possible, you can constrain demand at the necessary level. Of course, if food prices are a big part of the basket, even a tight monetary policy may have difficulty in reining to inflationary pressures, simply because the supply of food and demand for food will, by and large, determine quite a bit what food prices will be. And it's going to be very difficult for all the food prices not to disseminate all over the basket. By themselves, they're already a big chunk of the basket of the consumer, of the typical Nigerian consumer. Now, the central bank and the central bank credibility requires the central bank to try to do something about it. There are, of course, discussions within the central bank. We are aware, and they have been made public as well, of a reaction to those inflationary pressures that are of concern to the central bank. The Central Bank of Nigeria has many tools and many objectives together besides inflation that complicates the running of monetary policy a little bit. It's a very heterodox central bank. It tries to reduce supply constraints of food production through agricultural financing. It has had some success on the margin in the short term on that count. But of course, that provides extra liquidity to the markets. It keeps interest rates low in the markets, and that interest rate of its own benchmark rate is not really reflecting the monetary policy stance as we see. So in between, it's all instruments. In addition to all those two, the CRR, which is the cash reserve requirement that affects liquidity in the banking system. All of this is creating a difficulty of understanding even the monetary policy stance, which seems to us overall accommodative. And of course, an inflationary environment would require a less accommodative monetary policy stance. Even if a big chunk of these inflationary pressures come from food, and food supply reacting positively could reduce some of the pressures, but central banks have a harder time affecting food supplies than they have typically containing inflationary pressures through their main instruments of monetary policy that are traditional, as we know. We have some different views on the running of monetary policy and how to structure monetary policy. They are not new. We have published in our reports. We understand, we share the objectives on the social count of food prices and lower inflation. These are all very important, both to the central bank and to us, but the instruments applied and deployed, we may have some differences on that ground.
Thank you very much for that. So we have a good number of questions on FX and the FX regime and FX policy. Let me start with one on the premium between the official market and the parallel market. So person is asking if you see the premium further widening this year.
A tough question because, you know, every time an economy is trying to predict or project exchange rates, particularly in the short term, the economies gets into trouble simply because these type of indicators are very hard to project. Many would argue that it's what we call a white noise, and they simply have their own movements, a random walk. They can go anywhere, and a lot is dependent on confidence. So what I can try, rather than predicting a particular level for the parallel market, I can try to see what kind of fundamentals may actually help us understand future developments there. Because we know that the official exchange rate is not perhaps reflecting all of the fundamentals. We don't know what the rate should be, where it should be. And that creates part of difficulty. There is a healthy premium already between the official and the parallel market. That parallel market rate probably will be affected by the flows in the balance of payments, the various flows we were discussing in the presentation. Oil price is an important indicator there for the Nigerian economy. The international liquidity is a factor affecting flows to the country and from the country abroad. how they search for safety, which we have been experienced as of the last week, let's say, in terms of buying of treasuries, how that rebalances portfolio towards more safe assets, reducing appetite from risk-taking in emerging economies. That is a very important factor to understand the flows in the balance of payments and the supply of foreign exchange in that market. So all those things are extremely important. Looking into the factors affecting the current account exports and imports, looking into the factor affecting portfolio flows, FDI, all the push factors from the international economy vis-a-vis Nigeria, they are all relevant for the supply of foreign exchange. On the demand side of foreign exchange, confidence is always the main issue. And of course, the growth projections are important because imports are dependent on those growth projections. So the higher level of imports, more foreign exchange is going to be needed. So one would need to think about all the various elements behind the balance of payment, supply and demand for foreign exchange, and elsewhere in terms of confidence. Confidence will also affect demand for foreign exchange for protection reasons, for savers, for example, but also confidence affects investments, particularly FDI, and domestic investments that require imported capital, intermediate goods. So confidence is always a very important thing, and it's difficult to predict confidence. If you are a Keynesian, you would actually say that this depends a lot on the animal spirits. In the case of Nigeria, there are sufficient concerns out there that has been affecting confidence, positively and negatively over the several years. So one needs to keep in mind and try to understand what is the business environment, how conducive is for investments, FDI and domestic, to actually try to get some sense of supply and demand for foreign exchange to try to predict the path of the foreign exchange market. It's a long answer for a very, very difficult question that I would not dare to give a number and predict, because it would be irresponsible even to try to do that professionally.
Thank you. For concerning the Dangote refinery, so what impact do you see the Dangote refinery and the urea plants have on the economy and on FX liquidity in the market? Yes,
we have been hoping or projecting the beginning of the refining of petroleum products in Nigeria, and certainly Dangote is an important player there. It hasn't really started. We thought maybe Q3, maybe Q4 this year could happen. We'll have to wait and see. Maybe it will go over to 2023. It will depend. Certainly, the earlier the better. There is a positive impact of Dangote, but I don't think that we should overplay the positive impact in the sense that, yeah, you save something in terms of imported petroleum products because they will be refined locally, but you also lose the export of crude oil that is now going to be given to Dangote, or Dangote would have to import, compensating your exports. So yeah, you have an increase in the value addition of those goods. It's positive for growth. It may actually reduce marginally the price of the final refined product, simply because there may be lower transportation costs involved, because refining is happening within the country. If the logistics are there and can support transportation, some of the margins get reduced. That is positive for, of course, for reducing the subsidy, improving a little bit the revenue, a little bit improving the balance of payments and the purchasing power of the consumer. So you see some benefits coming from there. It will depend a little bit how this will play out, but it's not to an extent that will change completely the picture that we are seeing. It will have some benefits to the balance of payments, of course, together with some other initiatives to substitute imports away. But we have to wait and see a little bit. We had some benefit of increased rice production that reduced imports of rice, apparently, but that has caused other problems as well. And of course, once you produce your own goods, prices of those goods may be higher than the imported price, so there is an impact on the consumer and perhaps the quality of the goods. So all these things are also very important in considering when you do import substitution, and you want to make sure that it's sustainable, and that at the end, it's very important that rice producers in Nigeria will be able to compete on equal footing eventually with foreign producers, and hopefully they will be effective, and Nigeria won't need to produce to import rice in the future. And that is the challenge. And so we are all hoping for that. And this is true for any other substitution of imports. And in the case of production of refined products, certainly Nigeria has the comparative advantage. It has the oil. If it put in place an efficient production, it can have some benefits, but I wouldn't overplay at this point. Let's wait and see. And also, we are the IMF. The IMF is always a little bit more conservative than the average, perhaps.
Yeah, thank you. So you spoke during your presentation about the FX reserve projection, estimating it at around $400 billion and $40 billion, 41 in this year and next year. So a question here is talking about how do you see increased supply of FX to FPIs, that's the CBN clearing the backlog anytime soon, given the robust reserve levels?
Yeah, the last information we had on the backlogs was that the central bank was clearing them and has cleared most of them. If new backlogs appeared, it's hard for me to comment on this now. But what we certainly can say is that the foreign portfolio inflows have not returned to the Nigerian bond market or the market as a whole. It will be interesting for me to learn from investors what it will take for investors to return to the domestic market. Of course, what we observed after the pandemic with the backlogs certainly did not help to instill confidence from foreign investors in Nigerian bond markets. But beyond that, the level of interest rates may not be as attractive in Nairas for some of the investors. And whatever is their confidence level of rates, the risk rate return may not be attractive enough at this moment. So we do see still some investments from foreigners in the stock market in Nigeria, and some still in bonds. They may have decided to remain, or was not possible to repatriate all the funds yet. So, but most of the action of the foreigners that remain, we see in the stock market with data from the FMDQ. So yeah, it's not, the FPI is not at the same levels that they used to be prior to the pandemic. Yeah.
Thank you. That's one question on the fiscals. So it's about debt servicing versus revenue. So that at what point do you think investors would not be interested in extending further credits to Nigeria through Eurobond issuance?
Yeah, that's an excellent question, because the easy answer is to say, I don't know. because because investors will have to decide what is risk, and it's all a question of risk return in my mind. No, certainly the picture of that service and revenue is a mixed one. If you take the country as a whole, the country has enough revenue to service its debts. You know, if you take the revenues in all 36 states and local governments on a consolidated basis, debt service to revenue is not higher than 35%, which is a reasonable amount. Problem in Nigeria is that most of the debts, they lie on the federal government. The federal government is responsible for paying those debts, with the exception of some debts in Lagos State and maybe another 1 or 2 states. Most of the debts are government debts on the federal government side. So, in a way, the revenue that is collected at the federal level and not transferred to the states according to the debt burden sharing, to the revenue burden, the revenue sharing mechanism. So the available revenues to service those debts is a bit constrained, and that's where we keep seeing the 90% figure that pops up all the time, that most of the revenues of the central government are compromised or are used to pay debt service. And little is left for anything else in the fiscal space that is available without resorting to an overall deficit that needs to be financed elsewhere. So the key point here, the message is revenue mobilization is of the essence. Nigeria has to mobilize more revenues for macro stability and for being able to create the necessary fiscal space, to increase social spending, to do more infrastructure. And this is what we have been saying, because Nigeria collects about 7.5% of its GDP in terms of revenue and equivalent of GDP, and that's too low compared to any other group that you would wish to compare. Developing economies, frontier markets, sub-Saharan Africa, and you know the government recognizes that, has a program in place to try to increase revenue to GDP, mobilize more, increase it to 15% of GDP over the next years. That is ambitious. It's certainly the right policy to pursue. It will require tightening revenue administration, tighten fiscal policy on the revenue side, higher rates, including VAT, who has started to increase from 5 to 7.5%, but still much lower than the averages, which are about 15% in West Africa. So it's important that Nigeria starts moving in that direction, that it took a break because of the pandemic. Now growth is stronger, in a better footing. So thinking ahead, policies also need to move in the same direction. So just in a nutshell, to say that that service could be serviced reasonably well if the revenue would be much higher. So the liquidity issues that the Treasury is facing is more of a reflection of the low revenue than the high level of debt service. Of course, if interest rates starts increasing and debt issuances start being higher, particularly domestic debt service in the short term, then that service may actually increase significantly. So an extra motivation to collect more revenues, go there and collect and have the budget being well serviced with higher mobilization of revenues.
Okay, thank you very much, Mr. Aysen. Does the IMF have an estimate of the size of outstanding swaps on the Nigeria's FX reserve?
Yeah, what we say in our staff report in the Article 4, based on information from the central bank, is that these swaps and forwards, in fact, they are not as large as some may think, and this is what we actually suggest. We don't know the exact figures that they might be, but all in all, even if they are, the level of reserves at the moment seem to imply that there is reasonable coverage of imports.
Okay, thank you. So I'll take a few questions more before we wrap up this session. One on your growth projection. What's the 10-year growth projection for Nigeria in comparison to West Africa?
Yes. So the medium-term growth projection is not of a story of high growth, as Nigeria used to observe, unless, of course, there is a major shift in policies. And this is here the critical aspect. We don't know yet, but we certainly are recommending a shift in the policy framework, monetary, fiscal, structural policies, trade policies. Nigeria has huge potential. It has demonstrated its huge potential in terms of having high growth in the past. That potential remains intact, and one should be optimistic about it. But policies need to nurture the potential, particularly the private sector, which is the engine for future growth. So our view is that if you have a policy setting and a conducive environment on the governance side, on transparency, on rule of law, on various policies, monetary, central banking, fiscal policy, creating fiscal space in support of some of the critical spending that the private sector may not be doing as much. These are all critical. Trade policies to invite competition and stimulate a productive private sector. The private sector in Nigeria has already shown its brightness. You take the IT sector, it has been growing at double digits for quite a bit of time. It finally decelerated actually in Q4. We took note of that because everything that goes in double digits, eventually the base becomes too difficult. But the level is there. It's very important and it will continue to be important. And it's because of the capacity of Nigerians, despite the struggles of being able to be innovative. So there is a lot to explore there. And a lot of good things may come out of that. Leapfrogging some of the challenges that other countries had to face in the past. Just take telephone lines. People used to do copper lines, hugely expensive. You don't need any of that, and Nigeria doesn't need to invest what other countries invested previously. So these are all good news. And I think that they need to be encouraged, motivated, not through subsidies, not through unsustainable policies, but really giving the conducive environment that they can compete on equal footing with others in that environment and explore the opportunities in the region. The African Free Trade Area is a huge opportunity for Nigeria. Nigeria is the giant, and the small countries in the region may benefit hugely from production in large scale that Nigeria can do to its own population and beyond. So there are bright spots to be really taken advantage of if you change the policy setting to a more friendly environment to businesses, to the private sector. And with macro stability and with all these reforms, I'm sure Nigeria can move ahead and actually have very high growth rates, and very importantly, growth rates that are inclusive, that they create employment and they are sustainable over the years, because the past history of Nigeria is that Nigeria was growing at very high rates, but poverty was not declining at the same pace. That creates social cohesion issues that is not favorable for sustainable growth. We have learned the hard way that this is true within the IMF ourselves. We need growth that is labor intensive to take advantage of the demographic trends that we observe in Nigeria. And those entrants in the labor market, they need to have the skills and the human capital to respond to the labor demand from the private sector that hopefully will grow strongly. So all these things need to fit well. The agricultural sector needs to be mechanized. Yields need to increase. So there are lots of potential if the policies are put in the right direction, in our view, to actually get a long-term growth of eventually double digits, and that Nigeria will be a tiger that it deserves to be.
Thank you very much, Ari. That will be all we can take for this session. It was really insightful. Thank you for clarity. I would hand over to Muyiwa to give us the closing remarks.
Thank you very much, Blessing. And I particularly want to thank Ari for the very insightful session. Thank you very much for taking time out to share the IMF views on Nigeria to our clients. We really do appreciate your time and the partnership we've developed over the years. I would also like to thank all our distinguished clients and participants for taking time out of their busy schedule to join our session. The second session on the series starts by 3:30 p.m. and that's going to be on technology. The ICT sector is an area that has been growing exponentially. Ari also highlighted that, and that session also should be an exciting and useful one. And we look forward to hosting you then. Thank you very much for your time, and bye for now.
Thank you very much. It was a pleasure and an honor to be with you today. And thank you, Demola. Thank you, Blessing. Thank you, Muyiwa. You are all great colleagues, and we'll be in touch. Take care.
Fantastic.
Thank you.